All right, so the second part of this is easy compared to what we just did. All right, so investing and financing activities, like I said, they are identical to whether you do the indirect method or the direct method. So you do them exactly the same. You look at it and you try to figure out just, did you spend cash or did you receive cash? You got to look at what the handout we just did, handout 12-1. Is it an investing activity? Great. If it is, did we spend cash or did we receive cash? If you spend cash, you're going to take it away. If you receive cash, you're going to add it back in. Okay. So, no disposals of equipment, but this company, Under Armour, equipment costing $370 million and intangibles costing $10 million were purchased. So what do you expect they're going to show on their investing activities? So looking at just, we need to prepare the investment portion. What do you think Under Armour is going to do? Are they going to have an increase in investing?
Yes.
Yes? What'd you say? She said decrease. Who wants to break my tie? Jessica, are they going to increase investment or decrease investment? They're going to decrease. All right? Equipment costing $370 million and intangibles costing $10 million were purchased. If those items were purchased, they spent cash. So you're going to have to record that as a purchase of equipment, so a decrease of $370 million and a decrease of $10 million. So a total decrease of $380 million, showing that they purchased those items because they purchased them with cash. And you list them separately because investors are going to want to see what did you spend that on. Now, what if it would have read purchase of equipment with cash, $370 million, purchase of intangibles and other assets with a note payable? Only 370 would go on there. So you have to make sure if you're doing a homework problem, you read it carefully. Because I'll get an email saying I have the right answer and it's not taking it, and then you'll get an email back from me that says, did you read how they purchased that? That notes payable kind of slips right by you. You kind of assume because you're doing a homework problem on cash flows that everything is with cash. You got to make sure you read how they paid for it. They usually try to slip at least one by you, so make sure you're looking for that. All right, so then financing, see what I mean? A lot shorter. That was 2 slides on investing. Financing activities, we said, were things like stock or loans or dividends paid, things that help keep the company afloat, right? Ways of bringing money in to the company. Doesn't mean we don't spend it, because obviously we pay things back. Financing is the hardest section to look at and know what happened without going in and seeing what you did. Because if you look at investing and you see a minus $380,000, you know that you bought something. If you see a positive $380,000 in investing, you know that you sold something, right? At least more than you got. But if in financing, you don't know what happened. You don't know if it's stock, you don't know if it's loans, you don't know if you paid something back, because loans don't mean it's bad, does it? If you see, no, it doesn't mean it's bad. And if you sold stock, it's not bad. So you kind of got to look in and read the notes. So here they had 4 things happen. They had $60 million they paid in cash dividends. $1.27 million in long-term debt was paid. Another $1.33 million in long-term debt was issued. And then shares of stock were issued for $190 million. So what's going to happen in the financing section? A lot. Yes. All right. A lot. What's going to show for the $60 million in cash dividends? It's going up? Out. Okay. And we're going to subtract it. It's going down. Right. What about paying back $1.2 million? And we're going to subtract that because we paid back a loan. Here we took out another loan, so we're going to add it. And then we issued shares of stock, so we're going to add it. So in the end, we had $190,000 in financing. So that's not that much. But if you go into the detail, there was a lot of stuff going on. If you can pay $60 million, actually this is all a million, sorry. If you can pay $60 million in dividends, you're doing okay, right? $60 million in dividends is a lot. So to have that much cash to pay in dividends, you're doing okay. If they paid back $1.2 million in loans and took out another $1.3, Basically, that's a lot of companies do that. They pay back a loan and just turn around and take out another one. It's refinancing. All right, pay back one, take out another. And then they purchase some stock, or proceeds, or they sold some stock, sorry. All right, here they just kind of go on to the payments. The net effect of these transactions is the $60 million that we talked about. So here is our total statement of cash flows for Under Armour. Now, last week when we were looking at it, I wrote two other numbers on the board, which we didn't get to those numbers. But if you were to remember what they were, if you come down to the bottom of the statement, there's our 310 from investing. Here's our 380 from, operating. Here's our 380 from investing. Here's our 60 from 100. Where's our financing? Right there, 60 from financing. Then look here, this is our 130. I gave you guys that, and I gave you this 250. Those are the two other numbers in cash. When we first looked at the balance sheet had $130 million for beginning cash. Then it had ending cash of 250, and it had a changing cash of 120. And remember, one of the questions I think, Baja, you asked, we don't use cash. And I said no, and I wrote those numbers on the board, and I said, but we'll talk about them. That's why. When we're done, this number right here, there's 250 million needs to equal that number on the balance sheet, and it does. The ending cash number on the balance sheet needs to equal that 250 million on the statement of cash flows. So those last three numbers equal all three numbers on the balance sheet: the beginning cash, the ending cash, and the changing cash. So you don't ever have to use those cash numbers from the balance sheet. Now the numbers that don't go on here, two of the ones we just talked about, because when we did the statement of cash flows from operating activities, one of the things that we didn't do, because we did current assets, current liabilities, depreciation, and net income. Interest and income taxes were not in those, correct? Because they didn't show up. So they go down at the bottom here. Because doing the indirect method, interest is not a current asset. Income taxes aren't a current asset. They don't necessarily show up. So they go down on the indirect method, they go down at the bottom. If directly asked, they're an operating activity. But on the indirect method, they go down on the bottom. So they're just an other activity. So when we're looking at all this, what does it mean? So when investors look at a statement of cash flows, what are they supposed to be able to tell? It's great that we just did this, but what are they supposed to do when they look at it?
How are the companies doing?
How's the company doing? Right. And they're supposed to figure out, right, how much cash is actually coming in. So, do we want a positive cash flow over the long term? Yes. Okay, you can relate the cash flow statement to you very easily. We've talked about the income statement, and it relates to your living, right? Your job and your expenses very easily. Your balance sheet relates to you and your assets and your debt. The stockholders' equity is kind of like your house. Once you guys get a house, that's your equity, what you're building. So a lot of you guys don't really have that stockholders' equity part of your life yet, but you'll get there. But you have your assets and you have your liabilities. You have your statement of cash flows too. How much cash do you have? All right. A lot of people, this is where, especially in the United States, we don't have a good statement of cash flows. A lot of people are what we call cash poor. They might have a house, they might have a car, but a lot of times this debt exceeds the revenue stream coming in, therefore you don't have cash. So operating cash flows has to exceed and be positive over the long run. You can have a negative cash flows. We talked about that. Businesses that operate that are seasonal, you can be negative over the winter. That's okay, or negative over the summer, ski resort, but you got to be able. An upward trend indicates growth. So when you look at companies that are going like this, they're growing. One of the things you guys are going to do here shortly is you're going to pick a stock. We don't actually cover stock till chapter 11, but you're going to pick a stock and you're just going to start watching it and seeing what it does over the next 6-8 weeks until we get to chapter 11. And then when we get to chapter 11, you have a stock project. It's like 10 points, but you guys are going to fill out the different ratios and the different things that you learn in chapter 11. But we'll start talking about your stock, trying to see how it's growing. Cash flow positive is like a stock going up. Right? One of the ones that's gone up and keeps going is Google. And then look at the relationship between cash flows, operating cash flows, and net income. If net income is going up, should your cash flows also be going up? Should your operating cash flows be going up if net income is going up? Yes. Right? It doesn't have to be a one-to-one correlation. Net income could go up first, but then you expect cash flows to go up at some point. Otherwise, you're not collecting your accounts receivable. And I already mentioned to you guys the video that we watch. They didn't have any cash flows. They had tons of accounts receivable, but they never collected them because they were false. They were fictitious accounts receivable. And then the auditors never looked at the statement of cash flows. So you have to look at the statement of cash flows. All right, investing cash flows. Good, healthy companies tend to have a negative investing activity. Why is that?
Because they purchase new investments, new property, plant, equipment.
Right. If you have money, you typically spend it. All right, now that even relates to you and I. When you get a job, your very first real job, I call it a real job. I'm not talking about, you just smiled at me, Emma, but you know, okay, your real job, you're going to college, why? To get a real job, right? Whatever you're working at now probably is not what you want to do in 4 years or whatever it is till you graduate, correct? So you want whatever it is you're going to school to be. And every one of you guys named something different. I had at least 4 of you guys that said accounting something. So your first real job, what's going to be your first purchase, usually?
Car.
Usually it's a car, all right? Sometimes, today's world, not my world, some of you guys already have a car. But even if you have a car, sometimes that's not the car you want when you get your first job. You change cars, all right? So you go out. So you actually get that positive cash flow coming, and the first thing you go do is do an investing activity. When you get another raise, the first thing you go buy after that is usually a house or condo or something like that. You invest. Companies are the same thing. If you're making money, you invest. You just got to be careful not to invest too much too fast. And then be cautious of a positive cash flow in investing activities, because that means what are you doing?
You're doing nothing.
You're selling. If you have a positive cash flow, you're selling things. If you're selling things, that means you need cash. And if you need cash, there could be something going on. It's not always. You just need to be cautious. All right? Maybe that means you're downsizing. All right? Maybe that means you're getting close to retirement and you're just kind of closing some offices or that area is not doing as well. All right? Schnucks just bought out 19 Shop and Saves. All right? And they're going to convert roughly 10 of them to Schnucks. What do you think they're going to do to the other 9? Sell them, maybe, or keep them closed. Schnucks kind of had an angle. Well, Shop and Save went out of business, or going out of business. So Schnucks bought them with 2 things kind of in mind. One, they liked the location of some of the stores, so they wanted that location. They also didn't want another grocery store chain to go into them. They don't want the competition. So just because Schnucks has them and may or may not sell them, that's not a bad positive cash flow either, right? So you need to look at why they have them and what's going into them. They're not going to let another grocery store chain buy them. So they kind of did them for 2 reasons. All right, financing activities, like I mentioned earlier, it is really hard to evaluate the financing activities. You really need to go in and look at the notes. What are they doing? You got to look and say, why are they selling stock? Why are they borrowing money? Well, maybe it's a good reason. Maybe they're buying 19 Shop and Saves. Was that a good reason to borrow money? Yeah. All right. So you need to go in and determine why it's positive, negative. It's not that easy just to look and figure out what they do. So you need to go line by line, and you got to look at what's going on, look at the notes to the statement of cash flows. So it's a little bit harder to figure out what they're doing. Okay, now look at this funky little graph. So what it's trying to tell you is just kind of looking at what it means. And we talked about operating. All right, an operating activity, you're going up. This is all good. But what happens when your operating activities start going down here underneath this line? That means you're declining. You got to keep that positive growth and then above cash. This is your cash flow line. If you're looking at investing, you start off low, you get to here, and then you hopefully keep a positive cash flow. And then financing, you usually start off pretty high because you need the money to borrow to get going. And then you could keep it kind of right around here, but if it goes down into here, you're declining. So when you get the investing, you're declining when you start selling. So the key is to keep everything right kind of in the middle. All right, so Aja already brought up the direct method, all right, saying it sure looked a lot easier. Well, the direct method is not GAAP, so we can't use the direct method if you're a company that is on the SEC, on the New York Stock Exchange, you can't use it. But if you're not, you can use the direct method for the statement of cash flows. So the direct method does provide a lot more detail. So if you look at the net income, and we go down that way, there's not a lot of detail, right? It just says that we spent money on investing activities doing this. It identifies the inflows and outflows of relationships. It also prepared adjusting accrual to cash base, which is what investors do like. And then investing and financing are exactly the same. It's just that operating section. So what do we look at? Well, here's kind of the operating section. And when you look at it, just like this, cash collected from customers. It specifically tells you. On the operating section and the indirect method, it does not say, this is how much money we collected from customers. Right? It just said, accounts receivable went up. It looks at everything from net income. It doesn't look at how much cash you got from customers. It doesn't look, now here's inventory. We do have that, but it doesn't say suppliers or employees, cash paid for interest or income taxes, that's all below. So it's definitely laid out differently. But how do we come up with those numbers? So cash paid for or collected from customers, we have to look at sales, and then we subtract out the increase in accounts receivable. So there's three things that go on. If you look at just looking at the indirect method, all we look at is the increase in accounts receivable, right? Here you got to go get the increase in accounts receivable and then subtract it from sales. So you got two steps. These are exactly the same. However, interest expense was $30, but if there was a change in interest payable, you would have to take that into account because that means interest expense could have been different. Income tax expense is $130. However, if there would have been a change in income tax expense or income tax payable, it could have been more because if income tax payable went down, that means you would have paid even more. Cost of goods sold and administrative expenses are the ones that are even harder because in order to figure out cost of goods sold, you got to take what your cost of goods sold was, and then you have to look at what your inventory increased or decreased by, and you have to look at what your accounts payable increased or decreased by to come up with that number. So it's not a matter of just looking at what cost of goods sold. You have to look at 3 or 4 other accounts, get the changes in those accounts to come up with that one number. So you don't have to know this. We don't talk about it, but there's a lot more detail to this than there is the indirect method. So it's a lot harder to do. It looks like it's easier because all you see is that. But in order to get to that, because when you see cash paid to supply for inventory, that's not just the inventory number. You have to figure out how much of it was cash. And in order to figure out how much is cash, you have to go back to inventory and then go back and figure out accounts payable and inventory numbers. So it's a lot more. Trust me, you don't want to do it that way. All right, so that's the end of the chapter. So now what we're going to do is work some of these problems so we can make sure you guys really understand how to do this, which is usually vaguely okay. Vaguely. All right, so let's go back to the handouts.